There is a hidden housing market crash happening right now, and while many people seem to be unaware of what is unfolding, the real estate market, including the biggest home builders in the country, have entered into full-on panic mode. With numerous cracks and red flags emerging, what awaits us over the next few months could be a disaster that could even be worse than what we saw in 2008. Now, on the surface, the US housing market still looks to be quite strong, and the median home sales price remains extremely high at $410,000, just 7% below the all-time high at the end of 2022. Even when adjusting for inflation, this means that home prices are more expensive than at any other point throughout history, even above the peak of the 2006 housing market bubble. We can see that house prices have massively outpaced inflation, rent, and wages, mirroring exactly what happened in the previous housing market bubble in the 2000s, a red flag that we are in another bubble. And despite home prices being at these astronomical levels, mortgage rates have barely dropped at all and are still way above 6%. This means that housing affordability is at historically low levels, and looking at this housing price to income ratio, we can see that to buy a median priced home on a median salary will now cost you 40% of your income each month. This is the highest portion of income needed to be sacrificed each month on housing payments since the late 1980s, again exceeding the peak of the Great Financial Crisis, an incredibly concerning signal. To put into perspective just how unaffordable the housing market is right now, home prices would need to fall by 38% to reach the same housing affordability levels as pre-pandemic in 2019. Alternatively, incomes would need to rise by a whopping 60%, the mortgage rate would need to fall to 2.35% from the current 6.3%, or we would need a combination of all three of these things. Now, due to how unlikely it is to see mortgage rates drop or incomes increase by this much, all signs are pointing towards a significant correction in home prices. Housing affordability levels simply cannot stay like this forever and always do eventually revert to the mean, and we are possibly now seeing the early signs of this bubble popping, with some signs of major weakness starting to emerge. There are now a whopping 37% more home sellers than buyers across the housing market, the highest imbalance in recent history, as we continue to see buyers pulling away from the market at a much faster pace than sellers and widening the gap. And in fact, the number of active buyers in today's market is fast approaching the low seen during the peak pandemic fear in April of 2020. And as this imbalance continues to grow, we are going to see the market shift more and more in the power of the buyers, who will find it far easier to negotiate down final home sale prices. And this looks to already be the case in some instances, with Zillow reporting home buyers are seeing some of the largest price cuts in years, with typical listings discounted by $25,000. And we are now seeing a widespread decline in home values, with 53% of homes losing value over the last year, the highest share of depreciation in 13 years, and a further signal of initial cracks starting to show. There is also a tidal wave of new housing supply set to hit the market in the coming years, as homes under construction at all stages of completion are at historically high levels, thanks to home builders aggressively overbuilding since 2020. We've not seen these levels of completed new build homes sitting unoccupied waiting for buyers since 2009, now at 124,000 empty homes. Meanwhile, the number of new houses currently still under construction, and will therefore be hitting the market in the coming years, is at one of the highest levels in history too, at 261,000, not far off the peak of 2022 and close to the peak level in 2006. Now, yes, there is more demand for homes today compared to in the 2000s because of population increase, but this onslaught of new supply is going to make the demand-supply imbalance even worse and put downwards pressure on home prices. We can even tell how desperate the big home builders are to offload their inventory by looking at some of the very large incentives they are giving out just to make sales in the current environment. If the demand was there naturally for these homes at their current prices, then home builders wouldn't be needing to increase their incentives, which again is a clear signal that the market is in a weak spot right now due to lack of buyers. And these large home builder incentives are rapidly driving down prices of new homes to the point where new homes are now actually cheaper than existing homes, something that hasn't happened since 1971. Taking a step back and looking at the current state of the wider economic landscape, we can see that unemployment is continuing to tick upwards, with a firm uptrend forming now in what is potentially the beginning of a long-term cyclical trend where AI eats up more and more jobs across all industries. Now, high unemployment not only means that those directly affected have lower affordability, reducing demand and increasing supply from desperate sellers and foreclosures, but it also scares people away from buying due to fear. And in fact, as unemployment has started to rise, we've seen housing foreclosure activity rise by 20% year on year, while completed foreclosures have surged 32%, according to Atom Analytics. When people feel less secure in their jobs and concerns rise about getting laid off, they don't rush into making very large purchases like buying a house, and instead pull back, wait and build up more cash for their emergency fund. We are also beginning to see some major rental market weaknesses too, as US apartment rents have just seen their sharpest October decline in more than 15 years, making these investment properties less attractive to potential investor buyers, another toll on overall demand. And while all of this is happening, quietly in the background we are seeing a demographic shift that is negatively impacting the housing market slowly year by year, as birth rates are declining rapidly each year and will soon be outpaced by deaths. Ultimately, we will see fewer and fewer young people enter adulthood and need to buy homes, while an ever-increasing number of homes will be entering the market from the older generation. And this demographic shift will mean that there is a gradual growing wave of supply entering the market, but not enough new buyers to eat up this supply, all of which is going to put continued downwards pressure on home prices. With fewer and fewer buyers actually able to afford to take out a mortgage right now, with house prices and mortgage rates both still so high, Trump is now making desperate moves to prop up demand in the housing market, proposing the introduction of 50-year mortgages. Now, on the surface, this is a very clever move because it lowers monthly mortgage costs compared to a 30-year mortgage, and therefore keeps demand artificially higher because more people on lower incomes can afford to buy. However, there are many problems that come with 50-year mortgages, with consumers paying a far higher total sum of money across the time span of the mortgage on interest. And on top of this, many buyers using a 50-year mortgage will still be paying off their mortgage when they retire, or potentially will never pay it off in their lifetime, looking at this surging median age of US home buyers, which means that they will be passing on their debt to their families, which is a big problem. We are also seeing a widespread loosening of mortgage borrowing eligibility requirements, with Fannie Mae removing their 620 minimum credit score requirement. Now, this means that a wider pool of people with weaker credit scores can now take out mortgages backed by Fannie Mae. Now, the argument here is that there is more to determine someone's ability to make a mortgage payment than just a number in a credit score. However, scrapping this hard line in the sand removes a clear barrier that customers had to obtain to get granted a mortgage, and could be a slippery slope to allowing less reliable, higher risk mortgage customers. And this is a concerning step that almost mirrors what happened in the run-up to the 2008 housing market and financial crisis, where almost anyone was able to take out a mortgage. We are also seeing the Federal Reserve end quantitative tightening, and with interest rates coming down too, we are likely to see rapid M2 money supply expansion in the coming years too, and in fact it has already started rising in recent years. Now, with more money being pumped into the system and inflation looking like it could be about to rise again in what is potentially a second major wave, like what happened in the 1970s, this is another thing that is likely to prop up house prices, keeping them artificially high. And this, along with the other artificial measures that the government is introducing to increase demand, it could all mean that we may not see a massive housing market crash take place anytime soon, despite there being all the signs of a bubble that is on the verge of popping. A housing market crash, after all, or even just a large correction, will make a lot of people lose money and become unhappy with the government, a reason why the government will try and stop this happening at all costs, as it would be a very bad thing for their reputation. Now, the government may need to step in quickly to fix the job market, especially as the labour market continues to weaken every month, with more layoffs and less job openings taking place each and every month. The situation is looking so bad, it could be the trigger for the next major recession in the US and have massive negative consequences for the housing market too. Now, I cover all of this in my previous video, which you can check out by clicking on screen right now. Aside from that, if you enjoyed this video, please be sure to leave a like and subscribe, as that helps out the channel a lot, and thanks a lot for watching.